Let's bring in Tom Michaud, KBW, a Stifel company CEO and president, to discuss. Tom, thank you for being here. So I guess we can kind of start there. What do you make of kind of all of these warning signs that we've been talking about with regard to CRE, especially against the backdrop of CBRE saying last week in its earnings report that it's actually cautiously optimistic that the worst is over in office leasing, which kind of created more of a relief for the market, at least temporarily. So then when you see numbers like this, what are you thinking of with regard to the banking system?
Well, good morning. And also, we just completed our 31st annual banking conference last week, and so got a lot of really good channel checks very recently. Look, we are in a commercial real estate cycle. It really should be no surprise, and it's the reason why we're market perform on the banks. And even though they're at a very low valuation, we're not at an outperform on the sector. There are stocks that we like. Our view is we're about 2/3 of the way through this real estate cycle. And just to give you perspective, originations when interest rates were near zero in 2020 and 2021 were 2 times their normal rate. These mortgages are going to adjust. And they're going to adjust with lower vacancy. They're going to adjust with higher costs due to inflation. And we're going to see more losses, which, Leslie, as you study the industry, I know that you've focused on this, but loan loss reserves and provisions for banks have been essentially zero for years. We are going to see very large increases in losses. That is part of the banking business. We have a provision estimate for smaller regional banks for this year of 25 basis points. Over the cycle, maybe 40 basis points. So we see this happening slowly, and over probably the course of the next year, there are going to be more commercial real estate losses. We've built it into our estimates. It won't happen all overnight. And then the question is, how many outliers will there be? There will be some. And then the next question is this a systemic risk to the banking industry? We think with the capital, the earnings, and the reserves, it's not a systemic moment for the sector.
But I think it's important to kind of sorry, Tom, I didn't mean to interrupt you there. But I think it's important to distinguish between kind of those big 6 banks that are very highly capitalized, especially related to historical levels, and are becoming increasingly so in compliance with potential rules that are out there. But then there's also the regional banking space, which has been setting aside a lot more for loan losses and, kind of fits in a different dynamic with regard to the CRE ecosystem. So if you do kind of distinguish those, how would you characterize what's going on in the regional space right now?
You just did a nice job of laying that out. I think there are 3 banking industries within the banking industry. There are the big global SIFIs, the ones that we talk about as bulge bracket banks, universal banks, trillion-dollar asset sizes. You've got the mid-sized banks. Then you have the 97% of banks in America, which are below 10 billion. They all do different things, and they all look a little bit different. The smaller banks have more commercial real estate, and they tend to be less reserved at the moment. So we think they are probably at the greatest risk for an earnings surprise if a commercial real estate problem shows up. They're also less likely to lend in the big cities. However, there are going to be headwinds to earnings from those companies, and that's why we've been tilting for stock selection towards the higher banks, the larger banks.
Interesting. And I think
yeah.
Oh, I was just going to say, I think the market agrees with your prognostication there in terms of just the potential for some sort of downside surprise in those names. Tom Michaud, I really appreciate it. Thank you for your time.